even if you get it wrong, we're never going to time anything perfectly. I'll add a bonus one because you mentioned Intuit with the dip book and their kind of pivot that they did. Intuit's been a big winner for us in our front end, in our wide moat letter, the newsletter that we send out. We bought it late last year. The stock's up 25% thus far year to date. We're up even more, I think. And, so I'll throw up a fast graph for this. I think the shares are a little expensive here. You can see they're above the blue line on the fast graph. So there is no margin of safety. The jagged black line is above the blue line, which represents the 10-year average here. But, the benefit of buying kind of high growth stocks like this, if you look at the bottom of this chart, 9 out of the last 10 years, Intuit has grown at a double-digit pace. So even if you get it wrong, we're never going to time anything perfectly. When you're growing at 15, 20% per year on the bottom line, all you have to do is be patient. You hold those shares, and eventually that fundamental growth will kind of cancel out your mistake and even if you bought it when it was expensive, and make up for it. So that's why I personally love growth stocks. I personally love compounders, not just speculative growth. I'm not talking about revenue growth. I'm talking about bottom line growth, cash flow compounding. That'll cover up a lot of mistakes when you're investing.